Welcome to the July 12th, 2021 Advanced Report for McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, President, McGowan Group, and your financial weatherman with your weekly fast-paced tour of the global financial markets. Other YouTube videos have been posted called the Exceptional Investor Series. We'll be adding to that as we hit topics that can help you make great decisions as an investor. Here we are with the Dow Jones. We usually start here, but I have something to point out about this chart. What does this look like? Well, that's a trading range. You can see it right here. And this trading range actually began, if we take this right here, began in March. So we're in our fourth month of being between 33,000 and 35,000 on the Dow. These trading ranges, as you can see from the start of the year, actually can last a while. Right now, the question is, do we have a setback that could take us to 31,000, which would be this sticky level right here that you see. And it appears the range-bound market is a change in strategy from the raging bull, of course, we had for a couple of months right here. What are we going to do about it? Well, let's go through and see what's working right now. This is taking the S&P 500 companies, dividing them into different industries and saying, okay, who's doing the best? The blue line is energy, 41% so far this year. This yellow line, well, that's actually 26%. That's the healthcare sector of the S&P 500. And just below it is the financials. Well, the healthcare sector in the past 2 weeks woke up and passed financials as the top performing sector. That's notable. Now we go to the bottom performing sector and you get the industrials down here at the low sector for the year-to-date performances. Well, what does that tell us? Healthcare, medical dividends potentially, energy infrastructure could be solutions for inflation-friendly assets going forward if you were worried about inflation. This is the earnings of the S&P 500 companies. So if you take the basket of S&P companies after taxes, back in 2018 at the beginning of this chart, for the first time ever they made $40 for a quarter. That's an S&P basket. And that was after tax. You can see the pandemic low at about 25. And look, the third quarter, the expectation is record profits by about 12% over 2018. But the markets are about 25 to 30% ahead of 2018. Part of that is because interest rates are zero. There's not many good choices out there. Look at this. Analysts are usually, on this chart from Bloomberg anyway, analyst expectations usually overly optimistic. But these earnings reports begin next week. And looking at those earnings reports, most of these companies are reporting more profit than expected, with a trend that could take it another 20% to 30% higher by the end of 2023. U.S. companies weathered the pandemic and making record profits. That's part of the reason for the rally on the Dow to 35,000. What happened to interest rates this week? This is big news. And we had to question why. I'll give you a couple of premises that we've got good backup for. So interest rates on the 10-year Treasury, which drives mortgages, spiked up to 1 3/4. Remember all the inflation headlines. Lumber went fivefold, and you had huge increases in the commodity index. Oil too, which we're going to get to. But anyway, this week, the yield on that 10-year dropped to 1 1/4. That's a 0.5% decrease in interest rates while the headlines are screaming inflation. What's the source of buying? Well, the Fed's printing money to buy some treasuries. You had short covering, and you had the discussion of coronavirus variants. Apparently, the coronavirus has gain of function built into it, and that's where epsilon and delta and some of the things you've heard about question the economic recovery. That was part of the premise. But in this case, a surprising drop in rates. Scott Menard at Guggenheim saying it's pretty easy for the 10-year Treasury to go back below 1% or even to go negative as growth slows. Wow, the premise had been that rates had to rise. Well, maybe not. Let's see what to do on strategy. If we're worried about the economy, this says don't worry too much. 9.2 million jobs available. That's a record with distance. The number of jobs posted to be filled, up 2.5 million fresh new jobs waiting for a total of 9.2 million. That says the recovery is still intact and working. That's a number to watch, and we'll come back to it. This is the healthcare sector waking up. So you can see about June 15th, boom. Since then, it's actually the top performing sector in the S&P 500. So healthcare has woken up. Now we go to oil. Oil started the year at 47, went to $77 just before the holiday because people are using a bunch of gasoline. Gasoline demand back to 2019 levels over the holiday weekend. That says the recovery's in full swing and demand for oil and gas is essentially restored, with air travel having been the last piece. International air travel still waiting to be restored, if you will, fully. The vaccines into 2022 could set the stage for that. Now we get to the Chinese controversy. Didi did it. This is Didi, D-I-D-I. It is an app in China, a ride-sharing app, and they went public, and they went to $18 from an $11 IPO price. This is the first few trading days of the session this week. Boom, they hit a low of 11. What happened? Chinese government said, oh, we have security concerns about that app, so we just shut them down. They took millions from US investors, and then they essentially shut down Didi. At the same time, Alibaba and Baidu got slammed. Those two are down double digits in an up year for the market. Well, China's underperforming, especially the stuff that they sold to international US investors. That controversy waiting to unfold, and it really began here and accelerated this week. Didi did it. And you call into question the Chinese government. They just did a big Tesla recall, hostility towards US companies and their own companies that are listed here in the United States. I'm Spencer McGowan, President, McGowan Group. Thank you for joining us this week. Be sure to subscribe, share it with those friends that are interested in taking their investment skills to the next level. Thank you for tuning in to our YouTube channel. I'm Spencer McGowan, President, McGowan Group, your financial weatherman. We sponsor each week networthradio.com broadcast that has the charts and graphs, many of which you saw today. We also sponsor this YouTube channel. Be sure to subscribe for fast breaking news, an alert when we post something in a market condition that may have changed. Our goal is to help you as an investor make the right decisions at the right time. And that's part of what this YouTube channel is about, as well as networthradio.com. I am well served with a team of 10 people, including myself. And that team that cares is actually made up of people who devoted to your net profits and your success, as well as excellence in service. If you want an educational experience to follow this up, get to networthradio.com, themcgowangroup.com. Right here, we disclose our net client experience all the way back to 2001. What that includes, the bear market cycles of 02, 08, 2018, and the recoveries through the most recent quarter. That is true education of investors, and exactly how our clients have done, disclosed right here. Further disclosures, value at risk of loss. Yes, investments are going to fluctuate. That's part of the reason for this broadcast, and that can actually work to your advantage. We'll build that into your plan. So I urge you to go to networthradio.com, fill out the preliminary client questionnaire, a free 1-hour brainstorming session by phone or at the Crescent in Dallas, and we will map out a multi-year plan for you and your family that's appropriate. Just because we talk about a security on this broadcast, or any securities, doesn't make it a recommendation for your portfolio until you have that written plan. Thank you for tuning in today, and we'll be back next week as your financial weatherman.